business with my business partner, and just, the mistakes we've made, the things that have worked. We very much approach it as an kind of an experiment, almost, to say, hey, let's try this. Let's try it on a small scale. If it works, then we go down that path. If it doesn't work, hey, we need to change. And I've prepared a few slides, and like Dirk says, there's no such thing as a stupid question. Nothing's off the table. You're welcome to ask me anything. I'll let you know if I'm not comfortable answering it. And yeah, I think we're here to share and to learn from each other. This is an evolution. So I'm going to share my screen with a few slides, and I'm also going to give you a link to the slides if you want to download it and just make some notes. So you can just let me know if you can see the screen on your side. Dirk, are you seeing the slides okay there? Okay, cool. So I think where we want to start is a presentation around building a financial planning business. And so we spend so much time working in our business, serving our clients, that sometimes we don't get time to work on our business, looking at the bigger picture. I'll also tell you a little bit about my journey with a certified financial transitionist. That was quite interesting, which I tackled the last year, but we'll chat about that if anyone wants a little bit more information. So if you head to this linktree /Louis van der Merwe, you'll find a link there where you can download this presentation, because some of the parts might be a little bit more technical that you want to delve into. You'll also have all my contact details. If you want to send me a WhatsApp or any message, any platform you prefer, I'll gladly get back to you and answer any questions you might have. So where this started was, I started my studies at the University of Stellenbosch during 2005, 2006, and then the global financial crisis in 2008. And so what timing to start into the financial planning industry, where assets halved, clients didn't trust the financial planning system, and it was really tough to find a job at an independent financial planning practice. I went to go knock on the doors of Craig and Sue at Crew, and they said to me, great, you can join, but we're not in a position to afford to pay you a salary yet. And that was very much the theme at that point in the industry. I think slowly but surely it started to change, with people saying we need to pay someone a salary because it takes a long time to build up experience and to build up a client base. And so I found myself joining an auditing firm. At that stage, it was called Moores Rowland, and they later on merged with Mazars, thinking that I'm joining, a big practice. Meanwhile, the financial services part was very tiny. We were 6 people. It was independently run, and they just happened to sit in the same office, and there was a little bit of shareholding that Mazars held in this business. But it turned out that I built quite good relationships with my now business partner. That was my manager at that point. Building up the experience, getting to speak to clients, it started off in administration. It's not what I expected after finishing a degree in financial planning, after finishing my postgraduate diploma, but I also understood that having the benefits of knowing how the admin system works means that when you sit in front of a client, you can probably give advice that's easier to implement, and you can also solve problems. And so I think the first point here is, when you start out in any business, look for areas where you can make things a little bit smoother, be that your own business or be that joining an independent practice. And for most people where the business has run for many years, it probably starts with technology, right? You can find something small where there's inefficiencies, and you can try and make it a little bit smoother. And over time, I think people will start asking you, hey, how do I fix this? So at Mazars, we were fortunate to look after the Mazars employee benefit scheme, but only the medical aid. And so what I found myself is that after 2 or 3 years, I became known as the guy that can help them with discovery, which I almost pushed back a little bit against. We're here to do financial planning. But what I can see now, looking back, is that the relationships I formed in those early years, helping someone with their medical aid, those people became partners at auditing firms. They became financial managers of different businesses. They became HR partners at large businesses. So the relationships that you build up in the early days by just purely trying to help someone, that bears fruit in the future. And we might not always see that. It might take 5 years or 10 years or probably 20 years for some of these relationships to bear fruit. And by no means am I saying, only cultivate relationships because it generates business, but that is a byproduct of it. And when we chat a little bit about the marketing part, we'll get there. So started out, in the administration, and over time started wearing a financial planning hat. It was very protected because the meetings that we had were always joint with a senior financial planner. And so I really had a comfort zone around not having to worry too much about where do we source business, what do we do with these clients, how do we service them. And I got to get comfortable with the way the financial services business operates. Unfortunately, 4 years in, a new shareholder bought into the business, and we didn't completely agree with the direction that they wanted to take the business. That, coupled with the fact that the average age of the clients were in their 80s, I was very worried that most of these clients will be dead by the time I'm trying to build my career. And, it got me to a point where I had a discussion with my business partner. We felt passionate enough to start our own financial services provider. Sorry, I'll get back to this slide now. Our own financial services business called Wealthup. But, now I have 4 years of experience. And I think what I want to highlight here is just a report that the FPI put out in 2020, looking at advisors in the industry with a designation. That could be any of the three, with, certified financial planner being the one that we want to work towards. And only 5% of the representatives in South Africa under the age of 30 hold a designation. And what that highlights for me is that there is no major rush to build up your education. If we look at the next band, the 30 to 40-year-olds, 18% of the representatives hold the designation, and then 45% in the 40 to 50s. There was even, I think, 2 people over the age of 90 that were still active representatives and active with the Financial Planning Institute. But this focus on education and becoming professional in the way that you give advice, I think is playing out now, even though it's playing out very slowly. So here I am, young financial planner, about 4 years experience, and our business had challenges, right? Being able to serve a client is the number one constraint that we see globally financial planners report, right? You get to a point where you run out of resources. So finding a way to efficiently service your clients is important. And then look at the other ones, right? Building value in your practice, having something that you can sell one day, or having something that you can transfer over. We saw that in the business we were in. The shareholders took out all of the money at the end of the month, and they never reinvested in the business. And so for me, that felt a little bit strange. Number 3, improving efficiencies, finding ways for things to run smooth. And I think that holds hands with the capacity to serve your clients and ultimately build value in your practice. And then the bottom ones, getting better clients, better quality clients, clients that are willing and able to pay your fee. And then last one is just managing growth in your practice. And we'll talk about that when we think about, bringing on more team members. And so here we are starting Wealthup, which was kind of at a point where I thought, hey, this is way too early. But at the same time, I had nothing to lose. I didn't have a wife and a child to look after. I didn't have anything to pay. And my thinking was, I can always move in with my parents if this doesn't work out, or I can try and find another job. So let's give it a shot. And that in January, that would have been 10 years ago. And I'm really grateful that I did that, because that brought some autonomy in terms of my time. But it was tough. Those first couple of years was tough, wearing more than one hat. I was ready to be a financial planner. I was like, okay, I just need clients. What I didn't realize that now all of a sudden, I also have a business owner hat to wear. And how much of my time should be spent in front of clients, and how much of my time should be thinking about how do we build a business. And what you'll see here is that I'm trying to kind of prompt that business owner hat, saying, okay, when are we putting that on? When are we thinking about the business? And when are we thinking more about the clients? So we started with work of Angie Herbers, and she looked at things called growth barriers. And we can see here they define it as when your expenses increase faster than your revenue, you need to do something different. And that's normal for business. What's not always clear is where those growth barriers show up in our business. And the most common one in the beginning is marketing, right? It's getting in front of clients. It's bringing that in. I want to talk a little bit about how we approached marketing. After you get that solved, it becomes the technology and your team that service those clients. After that, it becomes service and support, having a group maybe of administrators. We tend to want to start there. Number 4 is around putting more formal structures of reporting and compensation in place. Number 5 is thinking of larger organizations and streamlining your sales process. And then lastly is innovation. And unfortunately, that's the one that probably derails us most, because that's the part that's a little bit, or at least for me, a little bit more exciting. It's a little bit more sexy. And that's the end. That's the part where you've already gone through these obvious growth barriers. And I want to show you this chart, and you can download it in the slides. And so when you look at the first growth barrier, typically for businesses that range between $300,000 and $350,000 in revenue, right? We have this fixation in our industry that, we need to look at the assets under management. But at the end of the day, it's only a business, right? And you need to look at what income is coming in. I ignored these figures because I think it skews it. What this helped me to say is, hey, is the marketing structure at least at a point where it's not causing problems? Then we can move to technology and professional talent. So be careful of where you start. You don't necessarily want to start with innovation and doing things in a completely different manner if you haven't solved these easier growth barriers. Obviously, this is just one firm. You can listen to my interview with Angie Herber. I think she's about episode 14 or 15. And she's a practice management consultant from New York that's got over 2 decades of experience. And they look at businesses from the outside in, saying what's wrong in your financial planning business. And so let's start on the marketing and the tech part. And maybe, Dirk, we should pause and just hear if there's any questions up until where we are now.
Sure. Any questions, guys?
If there's nothing popping up, then I'll jump into
Louis, I have a question. Yeah. Working with
Sure.
people like Angie, where dollars versus rands. I mean, obviously, that's an investment that you need to make. But I mean, were they cognizant of the different currency, or?
So that's a great question. This is actually a free report that she's published on her website. And so there's ways to, I think, gather information without hiring someone to consult in your business. And so this is purely just from me reading about her work. About a year ago, she opened up a platform for advisors where you can subscribe and you can download the information. This was not Angie saying, hey, this is what's wrong in your business. This is what happens generally in an industry. And I don't think South Africa is very different. Yes, we have some individual challenges, but if you're building a business, it seems to be similar. So I'm trying to apply the phases instead of saying, have we reached this revenue target? Hope that makes sense. But let's jump into the marketing. And this is quite an interesting framework from a company called Snappy Kraken. And they US focused purely on the financial services industry. And what was interesting for me was this last slide of a presentation they did, where if you look at their phases, the first one is get noticed, then you earn contacts, then you build credibility, then you start conversations, then you win clients. We want to jump in here at the end, right? Deepen relationships and flip back to referrals. But still, this felt quite lumpy and quite a long process. And so how I'm trying to approach things is to add at the top of your marketing funnel that people need to know about you. If they don't know about you, how do you expect them to resonate with the message that you're putting out? How do you expect them to like you? Because from the people that know you, there's definitely going to be a lot of people that say, I don't like that. Because you need to stand for something. If you agree with everything, how are you expecting your clients to say, I really resonate with that, or I don't resonate with that? So from the people that know about you is going to be a subsection, and it might be small or it might be big, that people are going to maybe like you. And I think Michael Kitts has also said the likability factor in financial planners is really important, because our clients don't want to work with people they don't like. You might be the best in solving some of their problems, but if you're not delivering a good service and the people can resonate with you and they like you, they're probably not going to stick around for too long. But more importantly, from the people that like you, there's going to be a subsection that trust you and trust you enough to give over some of the reins in terms of their financial decisions. Not to outsource it, not to send money into your bank account. And I'm pretty sure a lot of you have also been asked, where do I send this investment? What's your bank details? We've had that quite a few times. And getting to a point where, obviously you don't want to give them your own bank details, but getting to a point where someone trusts you enough to ask that question and to say, hey, I'm comfortable enough, that takes time. And we can't jump in there saying, almost on your first meeting, Mr. Client, trust me enough to place this. Trust really is earned, and it's earned by consistently, delivering on the things that you say you were going to do. So I've tried to simplify it, that marketing is about relationships. Those early days at Mazars where, I didn't really know how this would play out, I focused on connecting with people and trying to help them solve a problem. That's really paid off over time. But the dilemma is you need to be in this industry long enough. Sorry, my screen just moved. You can still see my slides. You need to be in this industry long enough to get to a point where these relationships also turn fruitful from a financial perspective. So the next part, I want to talk a little bit about, building a team. And this took quite a while in our business to get to a point where we're actually comfortable hiring more people, because it comes at a big expense. But what we realized is that if you only work in your business and tomorrow you pass away, then you don't have a business. You're just self-employed, and it might be a great job, but you don't have a business. And I would urge anyone to read Robert Kiyosaki's Cash Flow Quadrant, where he tries, and this is the author of Rich Dad Poor Dad. He tries to break down, what is self-employed versus a business owner versus an entrepreneur. And just the thinking around it is important. You don't always have to build an empire, but you want to have a team that serves your clients. And last year, we hired a 56-year-old musician with zero financial planning experience. And for a lot of people, that might be, what? Like, how do you bring in someone that's not young, age-wise, that's probably later in their career, that's trying this second phase into something he's passionate about? And so this came about. His name is Joe, and he was a client of our practice. And every conversation, I could pick up how passionate he is about financial planning. And he would ask me, how do I build my skills? Like, what do I need to go and study? And so we spoke through, what do you need to get? And what happened the next year with our reviews, he came back and said, hey, I've managed to get the certification and I've managed to get my studies. What now? Where do I join? How do I become a representative? I really want to do this. And so we had to create a space in the business because he had the right attitude. He had the right passion. Dirk, you always talk about the caring gene. That's important, right? He cared enough about himself, about his passion for financial planning, and the skills you can train. I think to my realization is that training the skills is also a tricky part, and creating a structure in your business where you have training and you have enough space to upskill someone is important, and it takes time. And once again, you need to be wearing your business owner hat and not only your financial planner hat. Once again, we relied on some of the work of Angie Herbers, and she's got a paper out called Diamond Teams. And the thinking here is that you have a group of people, not just one solo financial planner. And so the technical terms that they use is less important, but you have one person that's in connection with the relationship. You have lead advisors that's there to support the technical work. Think of kind of a paraplanner. And then you have an associate advisor that would be someone around administration and sorting out the paperwork. And together in this team, you can make sure if there's one person that's not there, the team can still operate. And over time, you help this lead advisor to grow into a senior advisor and have their own group where they service. And so this is the thinking when we're building out the business, to bring in younger people, but at the same time to pay them a salary, because they're not there to find business. The senior advisor is the person responsible for bringing in business. And I think that points to the relationships. You've had time to cultivate relationships. You have a source of new business. You can't bring someone in and say, okay, go out and go and find 100 clients or 200 clients. So start addressing these problems. When you're bringing people in, be hesitant of bringing a rainmaker in or someone with a big book of clients. They can change your business very quickly. And, happy to talk about that experience in our business where we brought someone in that worked for many years, I think about 15 years in the industry, and we didn't spend enough time making sure that it's a good cultural fit. And so it didn't work out, and we had to help him move his clients, and he set up his own FSP. But that was a mistake, right? And I only realize it now. The CFP board in America brought out this kind of chart around where the amount of people sit in financial planning practices. And what's interesting here is that there's different career paths. You can move into support, you can move into associate advisor, you can move into the servicing part where you're looking after clients that's maybe not generating new business. You can be a lead advisor and you could be a founder. And there isn't only one career. Not everyone has to be a financial planner. You can create these different career paths, and you can see the average years that someone needs to have spent to be in that position. Where founders, typically starting business, tend to be people that have built up experience. So don't expect to start there always. You can work your way to that. But in a business, your business has to grow fast enough for people to see themselves moving into these new career opportunities, which puts a lot of pressure on the business owners. And so the next part I want to chat a little bit about is using technology. It's a passion of mine, and I think for anyone that grew up, with the internet and with some technology, you immediately feel frustrated when you have to do things manually, or you have to post something, or you have to send a fax. There were still times where you had to do that. But if you have some autonomy in your business, you can start saying, how do I bring in technology? And I think what a lot of financial planners start with is they say, I want to use technology to do the financial planning better. There's a ton of tools out there that can just make your life simpler. Like for instance, we started using a system called Front, where a team can approach one inbox or multiple inboxes. You can chat around an email, and now all of a sudden our email system becomes collaborative, and you can hand it over to different people without sending an additional email. That's got nothing to do with financial planning, right? It's just the way we communicate. So I want to share a dashboard that we use to kind of keep track to see, hey, are we moving in the right direction? And this week's episode that's coming out on the podcast is with Gustav Nietling, and he runs a practice where they're in the process of building these key performance indicators. So on the right-hand side, and we use a system called Fathom. It links to our accounting system. I'll be happy to share the links. And it pulls in the information. And so what I look at on a kind of a monthly basis with my business partner are these things on the right-hand side, saying, okay, number one, what assets are we looking after? What amount? That on its own, I think, is a vanity metric, right? It's something that's not as important. What is important is how much revenue that's generating for your business. Remember, we're now wearing our business owner hats and saying what percentage is recurring, meaning that every month when you start, afresh, what percentage of income do you have a fair certainty is going to be coming in? And we try and target 90% of our revenue to be recurring. I don't think it's reasonable to have 100% recurring, because that means that you may be missing out on some opportunities. But a 90% recurring revenue has meant that we don't have the pressure around finding business every month. Obviously, it didn't start off with 90%. It took a really long time, but it took the focus of knowing where we want to get to say, hey, let's rather build a sustainable annuity-based income. And there's very few businesses in the world other than subscription technology businesses that can build this recurring revenue. My wife ran a clothing business, and every month you have to find new customers and you're starting from zero. There's no guarantee. Yes, you have boutiques that buy from you, and you have a certain sense, but we're very fortunate that someone once said it's the best get rich slowly scheme. And I think that's so true. You need to spend time building this, but once that engine works, you can start reinvesting back in your business. And so the next part we look at is number of active households. And that's information that we pull in from ComSpace, and I'll show you where you can get that. And you can see for this month, this snapshot that I took, our revenue didn't grow as fast as our target. So at the bottom here, number D, we have a specific revenue growth. And so we're targeting on average about a 15% revenue growth per year, and we divide it by 12. So we know how much our revenue should be growing every month. More importantly, is your business profitable? Because we can bring in a lot of money, but we can also pay it out. And so that maybe talks to the structure of eat what you kill, right? You take home, and some of the companies allow you to take home 100% of what you generate. That's not always a sustainable business, right? So we start thinking about what is the amount of profit this business needs to make to be able to reinvest back in it, to be able to invest and train the staff, and also to, at a point, fund younger generations of shareholding. And so this is something that we're working towards, building up some cash in the business for, just for bonuses or maybe some expenses that come through your annual levies that you have to pay. Surprisingly, there's a lot of expenses, and I'm sure a lot of you run your own FSP, but you need to be wearing your business owner hat. And then lastly, we look at gross margin and operating profits. So work with your accountant, start figuring out what's the important things, even if it's just one number. How many households are you serving? And why I'm saying households is that we realize that financial planning doesn't happen in isolation. It can't just be one person. And at the same time, you might have a family where there's a trust and there's children, and now all of a sudden you have 8 clients, but they're not 8 individual clients, and there might not be 8 individual profitable clients. So we started tracking them on a household level, because if one person leaves, they tend to take the family with them. And so we have this target of no advisors serving more than 100 households. And I think for a lot of people that might be, how do you get to a point where you only service 100? There's practices out there that service 20 clients, and they run a profitable business, they pay good salaries. It is possible. It doesn't always have to be 400 or 500 clients. So I want to challenge you, just thinking, how many households can I service profitably and still enjoy my life? We're doing this to fuel the lifestyle we want for ourselves and for our families. And I think sometimes we forget it. And lifestyle financial planning is about connecting that. And so when you think about your business, think about, what do I need to get out of this business for myself and for my family and for my staff members and for my clients, to find that balance. It can't be a one-sided relationship. It has to be mutually beneficial. Your client has to get more value than what they're paying, and you need to have a great lifestyle, and you can in this industry. I think it's one of the few industries where you can have a really good lifestyle without working the hours that maybe some of the corporates would demand. But that's enough me ranting. I want to share a little bit from the ComSpace data that we can get. And so ComSpace is a system where you can track your income. And we started doing that very early in our business, not to pay out commission to advisors, but to see how profitable are our clients. Because if you're flying in the dark, you have no idea, are you spending all of your time on unprofitable clients? There's a system out there called the A/B split system, right, of financial planning. And it's super simple. It's a way to segment your clients, where his name is Jay Cutler, and he focuses on the A segment, which brings in 50% of your revenue, the B segment, which brings in 30% of your revenue, and then the Z segment, which brings in 20% of your revenue. And when you look at your figures, the top 50% of revenue is probably a very small group of people. In our business, it's 16 households. They're bringing half of our income. The next 30%, I think, is about 55 households. And then the last 20% is more than 100 households. And so when we spend our time, we need to know, is it with Z, with B, or with A? And so what ComSpace helps you to do is to see how much of your revenue is recurring, how much of it is initial. What are the different sources that it's coming from? Is it renewals? Is it as and when? And so this is dummy data from them. It's not actual data from our business, but I'll be happy to share, if anyone wants to look at that. Then you can also see what type of products it comes from. Is it from employee benefits? Is it from fees that we levied? And interestingly enough, we're trying to build that part of our business, sending someone an invoice and then paying it. At the moment, it's about 2% of our business, which I find really difficult to increase because people are not 100% comfortable paying for an invoice, although they are starting to get there. They're saying, I realize that this advice costs something. If it's someone that's been burned in the past by financial products where the fees are hidden, they tend to be more likely to pay fees. But at the same time, that is a once-off payment. It's not always bringing in a recurring revenue. So you can see, what percentage of your business is recurring and over what amount of clients from ComSpace. And so you can also do this in Excel and bring in your own commission statements. For the fee that we pay in ComSpace, I think it makes a lot more sense just using a system. This looks at organic versus acquisition growth. It's really how much new business are you getting from existing clients versus new business from new clients. And what we try and do is rather get what they call a bigger share of wallet from our existing clients. And Asset Map really helped us with that, where now you have a picture of this client's whole financial life. It's much easier to help someone with existing accounts that you may be not looking after or existing financial problems. So generating organic growth in the business versus just trying to get new clients. I think it's making sure that you have a balance of the two. And so last one is just looking at the age distribution of your clients, making sure that you have a sustainable client base. But at the same time, it's the people that tend to be in their later years that have built up these assets. So what's important in our business is try and build a relationship with the second, and in our business there's even a few third generation relationships where we're helping the grandchildren set up tax-free savings accounts and working with the parents. And so you always want to look out for the risks in your business. What can derail your revenue stream? What can derail your marketing? What can derail your business? If you have one client that's making up a massive chunk of your income, work through this scenario. What happens if we lose this client tomorrow? What happens if he passes away? What happens if there's these scenarios? Don't fixate on it, but make sure that it's not going to close your doors. And so the last part, I think I'm preaching to the converted here, saying that there's a community. There's people that are willing to share without a hidden agenda. There's people that will help you build this. You don't have to do this alone. I've tried to bring that message through interviewing financial planners in South Africa. We have Russell here today, but you can also see people like Gugu and Lisa and Mark just sharing their stories and sharing the things that worked, but at the same time sharing the things that didn't work. Almost everyone, and myself included, get to a point where we say, yes, maybe I should be doing something else. This is not working. And Seth Godin talks about the dip. And when you think about that, like, is it time to get out or is it time to work through the dip? Most people don't work through the dip, but it's going through that dip that builds the courage and builds the ability, to stick this out. And if you do that, I'll guarantee you that the value that you get from your relationships with clients is probably better than any other industry or profession. And the financial gain that you can get from this is probably better than most other industries. And so with that, I'm going to stop the sharing and just want to thank you. You can head over to that link tree and you can download the presentation, or you can send me a message or book some time. Thank you, Dirk.
Levi, thanks so much. That was wonderful, really, really insightful. I mean, Excellent. There's so much there. I think we're going to have to watch the recording, and I'm not sure where you get the time to do all the stuff that you do, podcasts, see clients, and then still do all this research, do all these the IT junkie stuff. But it's quite amazing. We obviously, I think all of us use some of the tools that you use, but I think, yeah, it's just interesting how you bring them all in. But before I open to questions, something I have so because this is a young group of planners, and a lot of them have not been tainted by the industry, and well, what they've seen they don't like, especially when it comes to around earning, how they earn their fees, how they charge their clients. So, I mean, you've said it there. You try and be fee based, which means invoicing, but that's 3% of your income. So I'm assuming the majority of your income is AUM of sorts, a scale of that. And I've been quite strongly saying to these guys that, because you're on this group, your heart's in the right place, and it's more important that you stay in the industry rather than try and be absolutely 100% pure, because we know, those of us that have tried, it's simply not that easy. And if you aren't able to feed yourself and your family and run a business profitably and pay staff and have systems, then you're simply not going to survive. Just if you can share with us your experience around that, because I would imagine it's something that you maybe started off thinking very strongly about, but maybe you've had some thoughts around where that is and where it's going.
Thank you, Derek. Yeah, I think that's a great question, and it's something we can debate endlessly. South Africa is obviously in a unique position where we have a lot of clients that need advice that can maybe not afford it. And what I've had to realize is that we're not necessarily in the game to save all of those clients, but we can still make an impact in their lives. And so when we started out this business, I put myself in a position where even if it failed, I knew that, like I said, I can move in with my parents and I didn't have expenses. So my first point would be try and, get things to play in your favor. Try and keep your lifestyle expenses low in the beginning years of building your business. Try and make sure that you have some cash. I just jumped into it, right? I had a month's worth of expenses and I said, okay, we'll figure this out. You also have to have a little bit of blind faith at some point and confidence in yourself, because it will work out. It just depends on how much time you're willing to work at this, right? Is it 6 months? I think your expectation might be very skewed. Is it 3 years? Is it 5 years? What I've seen through talking to people, it seems to be the kind of 6 to 7 year sweet spot where someone gets to a point where they've been doing this for long enough. They've had enough connections with people. They've built enough relationships, and they're now coming back to them saying, oh, I have this problem. Remember, any business is built to solve a problem. And so how I think about what we're charging is that the value that we deliver has to be more than the fee that someone's paying. And so that fee can be in the form of assets under management. It can be in the form of commission, because they are still paying that fee, even though it's via the product, or it can be in the form of an invoice, right? And so those three combined, I think you have to say, what is the value that you're delivering? And don't discount the value, right? Just being there to ask difficult questions for a lot of people is immensely valuable. It doesn't always have to be about the financial product. I had a conversation with a business owner yesterday that was thinking about, shareholding and starting a new venture. And through a couple of questions, which, the coach training really helped with that, couple of questions, we can just get to actually what's holding him back, right? And it was, I don't want to disappoint these people. I want to give away half of the business because I don't want to have difficult conversations. That was a 20 million rand conversation, right? So we don't always have to have a conversation about the financial products. So start thinking, how can you add value? And, if you're charging someone 10,000 rand and this is even 100,000 rand conversation, you're adding massive amount of value. And where can you actually demonstrate value? Well, you can demonstrate value in things like tax planning, things like estate planning. I would argue that your value is not in selecting the right fund managers, because that's become commoditized. A lot of us use discretionary fund managers. Be careful of falling in that trap where your clients see you as having to pick the right funds, because ultimately you're not going to get that right, right? And what happens then? So start asking asking this question to your client. Why have you decided to partner with me? What's the value that you see in this relationship? And so I started asking new clients, how do you see a great financial planning relationship? Or, what is it about? And if they say, well, you have to make me money, I'm like, I run. It's like, that's not, you can challenge it. You can say, well, why is that important for you to make money? But setting those expectations at the beginning, the only thing you can guarantee is that you will lose their money at some point, unless they're sitting in cash, but that's a different discussion. So if you approach it purely from, are you fee based or are you fee only? I think we get stuck in the way we remunerated, because this is about the massive value. And I think the guy's name is Matthew Jarvis. He put out a book called Delivering Massive Value. And financial planners deliver massive value, right, through our conversations. And you can demonstrate it to your clients over time. But if they're there for you to pick the best fund manager or for you to get them the cheapest insurance, start thinking, is this the right fit? The clients that pay the least are generally the ones that you spend the most time on, right? If you look at the creative industry, so people running advertising ads, they often put out this thing about, the $500 client sent me an email saying, we need to discuss this. It's a massive investment. Where the $50,000 client said, money sent, thank you so much, right? I think it's all in our head. And so starting to work with clients where you think, oh, that person's financial planning must be in order. He's the CEO of this company. That thing of more money, more problems, it's absolutely, they don't have the time to solve these problems. And so think of the client that you like working with and move one level up, saying, who are these people that can afford to pay me? Because if you're here, it means you care about those clients. And that already puts you in the 1% of our industry. And so it means that you can charge a premium, right? The fact that you care, the fact that you're going to be there when they pick up the phone, the fact that you're going to be there when one of their loved ones pass away. How do you measure that? I don't think you can measure that. And so I think it's back to getting comfortable with knowing how much value you add in someone's life, and then saying, what fraction of this am I comfortable charging, and sticking to that.
Yeah, Louis, I love what you say about, and this group must listen, value over time, because, it's so difficult in what we do to say, well, here's my value proposition. We know, those of us that have been doing this, that it's value that is experienced over time. It's an experience that clients need to go through. And as you say, if you have that care gene and you really care, that is going to come out over time. Okay, guys, questions for Louis?
I see Justin had a question in the chat.
Justin's asking about the number of clients, and I think you answered that.
Sorry, I see his question. Yeah, so we have a cap. We don't necessarily have a target. It's something that we're trying to work towards, saying, what should we grow? But the responsibility is with myself and Marius as business owners to bring in business. The responsibility is not with the rest of the business to bring in clients. And so I don't want them thinking, where do I need to find a client? Because those type of clients that they're connecting with is usually the ones that maybe not as profitable or not the right fit for the practice. In our business, I don't think you can serve, or the way we set it up, we can't serve more than 100 households each. I mean, I'm running around with, about 68, I think is my current amount. So it depends on what you want to do for them, right? If the only thing you do for them is, an annual review and here's your investment, great. We started looking at other areas, right? Working outside of their financial planning, working through these large life transitions and being their sounding board. Because I always think, what happens if tomorrow, for some reason, we lose our license? And that can be legislation. It can be something that happens. Hopefully it never happens. But what if we're not able to provide advice on financial products? How do we still have a business that someone is willing to give us money? And so I think what's happening is that it's through the more difficult conversations, and it's being able to nudge them to like this guy yesterday that didn't want to have difficult conversations with his shareholders, like start having that, prompt him. And if you're doing it with a caring way and a kind, gentle way, I think people would be more than comfortable to pay you the value that you add.
Ben's got a question.
So yeah, you just touched on it a bit there, and I just wanted to ask, are you seeing a big kind of, I mean, obviously clients generally come in because they got some sort of financial question that they have, but are you seeing like a shift now to more like coaching, or like you said, transitioning, in different lives? Are you having more of those conversations, and are you maybe being more intentional about that? And how do you then actually facilitate kind of those conversations throughout the year with your clients?
It's a great question, and it's something that took me quite a while to figure out where this fits in, because there is this trend that everyone's saying, hey, you need to get coach training. And so I went along with the trend. Okay, let's get some coach training. Does that mean you become a coach? No. What that helps you is the way you have conversations with your clients. And actually, it's just about listening. You're listening in a different manner. You're listening for what they're not saying. So when a client comes in, think about it as how a doctor would go in, right? They have this presenting problem. Oh, I got a message this morning from a new client saying they need to talk about their will. Okay, cool. That's a presenting problem. If they have an issue with their will, they need a new executor. Once you start asking questions like, why is this important? How much time are you spending thinking about this? The kind of coaching questions to delve a little bit deeper. You're trying to figure out what's behind this. Now the stories come out around, oh, my parents are giving us money from a trust. Oh, but actually my parents are worried because they're getting to a phase of their lives where they can't run the farm anymore, right? Oh, actually my dad's been diagnosed with a terminal illness. It's not about the will, right? It's never about the financial product. It's about their life. And I think that ties in lifestyle financial planning, and the coach training helps you to listen about that. And if someone knows that you care, they don't worry too much about the financial outcomes. They don't worry too much about the technical details. That's important, right? That's a given. If you're going to a financial planner, the technical part has to be correct. I'm not saying, don't spend time on getting that right, but that's not necessarily going to differentiate you. And so I think what the coach training has helped is to start thinking differently when someone speaks, to actually say, well, what's going on here? And not to be like, oh, I'm going to be nosy. I think you have to approach it in a very gentle manner. A lot of people are maybe not comfortable sharing the information on the first or the second or the third or the 10th meeting. So getting them to a point where they're comfortable sharing the things that they're worried about. Because our job is getting someone to feel comfortable, knowing that they'll be okay, even though the ride's going to be difficult. And so why I went through the transitionist planning is that we had a widow that came in, and I could see, the distress on her face and how much suffering there was. And I didn't have the tools to deal with her. I jumped into, okay, this is how your living annuity is going to look. And these are all the decisions to be made, because I didn't know, right? I didn't have I had the awareness to know that this doesn't feel right, but what else do we do? Now there's a structure. I can share with them, this is what people go through when they go through a major life-changing event. It's okay not to be okay. And let's decide what is the most important things that are time sensitive that we're going to tackle. And we put that in a now section. What are the things that might be coming up in the next couple of months? We put that in a soon section. And then we put the rest in later. And now that person knows, hey, I don't have to tackle everything. That process alone takes off the feeling of, oh, I need to do something, like my partner just died or my spouse just died. I need to be doing something, and just normalizing what they're going through. I think that makes the delivery of the advice that much easier. And when you then get to a point where you say, this financial product solves these problems, right? I think what Maura Summers talks about is delivering advice that sticks. That you can deliver advice that and like, this is the right thing for the client. That means that you don't lie awake at night thinking, wasn't that the right route? Should we have gone something else? That might still happen, but it happens a lot less. And you can see that the client has buy-in. And so where that doesn't happen is in a transactional relationship where someone comes in and to buy a new will, right? Okay, let's go through and let's set up this will. What they don't have is they don't have the peace of mind because you haven't solved any of their other problems. You know, this problem of the worry about their parents and the terminal illness, that's still there. Yes, their will's now sorted out, but, you know, where have you added value? Have you added value in delivering a product, or have you added value in that peace of mind, that kind of that space where now maybe they get to actually go to work without worrying too much about this, or they get to spend time with their family? If you start thinking about what your role actually is, I think it's almost to reduce that suffering that people go through. And life is tough. You know, you can't, most times you can't fix the problem. But just having someone where that client feels comfortable talking about it, that think of it as a tire. You know, if you release some of the pressure, you know, you've changed that person. That person is now more comfortable and they can start thinking about it and they can organize their own thoughts. And so the coach training, I know this is a long answer, the coach training helps you to listen for the things they're not saying. And then if you have a framework to apply that to your financial planning process, of which transitions planning is just one framework. You know, George Kinder's life planning is another, and there's hundreds of different frameworks. If you have a framework to attach this to, you have comfort knowing that there's a process. And they always say, trust the process. It helps. It helps knowing in your mind, okay, this is where we are and this is what we're working through. I'm not sure if that answered your question, but it might have prompted a lot of new questions.
Yeah, no, there are a lot of other questions. So just very quickly though, and so say for example, I just sent you a message and said, hey, I wanted a will, or for example, you know, would you say cool, and then meet and we discuss and you ask those probing questions in that meeting, or would you say actually we've got a process, let's go through this process first and kind of get to it later on? It's a sort of, how do you, with your need and process, how do you marry the two together?
It depends on the client. You know, some clients are super driven, and you know, if you look at the Enneagram assessments, there might be a number one. I just need to get this well sorted. So don't move or don't redirect that energy and saying, okay, you know, let's go through this. But before we start, just tell me, why is this important to you? How much time have you spent thinking about this? Like, what happens if we get this right, and what happens if we get this wrong? Starting to ask that type of questions might open up a whole new conversation. Sometimes, you know, they really just need a will. Sometimes there is nothing. But I would say that's the minority of things. Also framing it just to say, you know, to help give you the best quality of advice, I just need to have a bigger picture of what's going on. So can you help me by giving me a little bit of context of where this fits in to, you know, what you're currently going through? Just, it can be as easy as that. It's really just asking and listening and asking and listening. And so I don't think our clients want to be forced in a process. They don't necessarily, but we're at step one now and we have to go through that. That's my preference, is not being too rigid, but you know, someone might have a rigid process to know that, you know, we don't miss anything. I think that's important, but if your client has a great experience, they feel comfortable, they're still getting what they're asking for, or they're getting more than what they asked for. So there's a coach training school called Thought Smiths, and Dirk, I'll send it to you, the kind of structure that they use. They use a stakes model. But what's important in the stakes model, it's an acronym that stands for different phases, is the bookends. It's starting the conversation saying, let's just define the problem that you have. And they use wording that says, I would really like to, but. And so you get the client to fill that in, right? I really would like a will, but I haven't had time to speak with you, or I can't decide on a trustee. And so then you take them through the thinking, you know, going a little bit more deeper, defining the problems, and that's a process. And at the end, you reflect back on that. You say, Mr. Client, you had this problem that you wanted, or Mrs. Client, you had this problem that you wanted a will, but you couldn't decide on a trustee. What did you get out of this conversation? I guarantee you it's always more than what they expected. It's always, wow, I thought about the trustee, but actually I have all these other things that I need to address. Or, you helped me make a great decision and I feel very comfortable. So think about that kind of bookend. And I think the stakes model is a great model that you can, it resonated with me, and you can attach your process onto that.
Louis, I believe you're the third person to become a financial transitionist. Can you tell us a little bit about what it is, what it means, and what you go through and what you learn, things like that?
Yeah, it was a very interesting process. And so a little bit of a history of where the Transitionist Institute comes from is a lady by the name of Susan Bradley. And Susan Bradley started a company called the Sudden Money Institute, as in you suddenly get money. And she worked with a group of divorcees that were awarded large sums of money. I think it was like $200,000 each. Now, this is 20 years ago. And she spoke to the attorney that helped this class action suit. And she said, what happens to these people like 2 or 3 years later? And he says, well, most of them don't have the money anymore. They've either spent it, or, think about when you win the lottery, you tend to become, where you were a couple of years later because you haven't changed the way you approach money. And she said, surely someone must be helping these people. And, his advice was, no, not really, because they don't have money. And so that prompted her to start thinking about what happens when you get this big windfall. Sometimes it's positive, winning a lottery, winning a legal case. Sometimes it's negative, getting an inheritance, or even retiring. That is a massive life transition. And so they termed this, and there's someone that did research around these life stages. And they spoke about transitioning from one life stage to another. And there's 4 stages of a transition. The first one is anticipation. You're waiting for something to happen. Then there's ending. Like that could be someone's diagnosed with a terminal illness. You're in anticipation. That person passes away. Life's never going to be the same again. Can't undo it. You go through ending, and that's typically where someone mourns and there's grief, and you shouldn't be making major financial decisions in that phase. The third phase is what they call passage. And that's the part that you can think of it as the messy middle. It's maybe 3 or 6 months after someone's spouse passed away. They start saying, okay, I need to put my life back together. I can start thinking what this new life might be. But there's things that derail them, right? Most of it being emotional. And because 90% of our decision making is driven by our emotional side and not our prefrontal cortex, your brain, it's the training around that emotional side that the Transitionist Institute focus on. And they say, money has a technical and a human side, technical being the certified financial planning part, the taxes, that, and both parts are equally important. Yet we spend very little training on the human side and the emotional side. And so the tools that they have packaged, I think there's about 40 different tools you use when someone goes through a specific way of dealing with a transition. So it's not, hey, you're retiring and therefore you need to use these tools. It's what's derailing them. So sometimes they might have physical fatigue, they can't get out of bed, and there's a certain process that you would then follow with them. Sometimes they're combative, they're just on a warpath and they feel that, what they went through was unfair, and there's a certain process to handle that. So the training focuses on the structure that they put in place. And so the structure, they call the protocol. And the first one is create a safe space, right? And so that's being able to listen to a client, getting them to physically feel safe and not in harm, knowing that, they might not end up with a financial product after the first conversation. So we spend a lot of time creating a safe space. Then the second part is what they call move to the balcony. So that is really just helping someone to see their life from the outside in. Because when you get stuck in the details, oftentimes it's valuable having someone reflect what's going on in the bigger current of things. And the third one, which is the one I struggle with most, is giving the work back. Actually, you should empower your client to start working through this process and not say, you need to do this, you need to put this in place. It's getting to a point where they say, oh, I think this is what's going to be best for me, and let's work together to get there. And so the structure that they've created is around those 3 main pillars of the, they call the protocol, and they help you with each of the different tools. You have a monthly check-in with their trainer. And so the group that we had, I think there was about 7 people in the group, of which 3 of us ended up writing the exam. I was the only one from South Africa. There was one other guy from India, and it's generally, you have to have a certified financial planning designation, and you have to have at least 5 years experience in the industry. And then they focus on, talking through client scenarios, talking through what worked, what didn't work. So it's not technical at all. Yes, there's a textbook where you learn about stress and how a stress response is and what people typically go through. But that's a very small part of it. 80% of it is getting comfortable with using these tools with your clients. So, you would have to give feedback on how did this specific tool work with your clients. And what I realize is that it's not important that you use the tool. It's important that you have this kind of framework for discussion. And I always thought back of that widow. Yes, if I just had this, it would make life so much easier. We would have this discussion and we would be able to make decisions that serve her better instead of just rushing through, making a decision. It turned out well, but oftentimes you make decisions that are terrible because you're just not in the right space to be making that. And so going through, it's a 12-month training process. And at the end, you have to do a written case study about one of your clients that's going through a life event. And, if you're dealing with clients, they all go through transitions, small or big. And then once you do that, you write 3 groups of exams. That's, I think each of them was 2 hours long. So that was quite a tough one. And they have a 70%, you have to get more than 70% to pass. And if you pass that, then you can become a certified financial transitionist. And so I think the designation maybe just helps clients to know, this person has had some training in the human side of financial planning, which I think is valuable. What I'm trying to get to is to mainly work with widows and divorcees, and to have the certified financial planning, the transitionist, and working towards this kind of fiduciary practitioner that understands the estate administration and dealing with the executor. And I think that would help me create a part where I can do work specifically with widows and divorcees, where they have, big financial decisions to make. They typically haven't had a lot of guidance, and they typically haven't had guidance through someone that's trained in this. And I think that helps me create a niche where I can add more value that I'm charging. How to charge for this is still tricky. I haven't figured it out yet. For our clients going through this major transition that do not have sufficient assets, we charge a 2,500 Rand subscription fee on a monthly basis. And we would have a monthly call, right, where we unpack what's going on in their lives. And it's just listening. It's just listening to what they're going through, creating some context, normalizing it, deciding what we need to tackle, what's on the now, what's on soon, what's on later. And yeah, it's been expensive. I think in South Africa, because I had to pay in dollars, it was probably too expensive. Fortunately, in the business, we built up cash, and I think it's important to reinvest in yourself. And so we were in a position to say, okay, I really want to work through this. There isn't really many other structures of training that you can go through, other than maybe getting, some training in grief counseling and those kind of things. This really brought the financial planning element as part of this, saying you're a financial planner first. That's your role, right? You just now have different skills and different ways to have conversations. And yeah, if anyone that's interested in this, more than happy to share with you what I've learned and show you the tools. If I'm thinking back, I think it was valuable, but I'll only know that, in the next 20 or 30 years, with the different interactions and the different conversations that I'll have with clients.
Thanks, Louis. So, you've been at this, I gathered, and my maths is good, for about 16 years now. And you're way ahead of I think all of us. But we have people in these groups so we've got youngsters who are starting out. So they're either working on their own, they're either in an auditing firm and trying to start on their own, or they're a young planner in an established business or in an old school type business. We've got people here who haven't taken that leap yet, who are wanting to take that leap and trying to find out the best way of doing that. What advice would you give to someone who has limited resources, limited confidence in this, because the stuff you're talking about comes with years and years of experience? I mean, what do you believe are the most important, if I could call them, tools that a young planner needs in starting out in the industry to be successful?
So Dirk, I think how I would approach this is to say, what would I do if I had to start over today? And what has worked? Well, what has worked is, partnering with a financial planner that has more experience than you and that's got more insight than you. So finding that mentor, mentee type of role. My business partner is 62 now. And so that's worked out really well because I learned a ton and still learning a ton from him. And likewise. So it has to be a mutually beneficial relationship for the mentor and the mentee. There's a lot of people out there that's willing, to partner with someone that's younger. I think be very mindful of where you spend your time and be hyper focused on what's going to pay off in 5 years' time. But to do that, you have to get past, the immediate threat, that lion behind the bush. Like, you have to sort that out. So my mission when we started the business was to make money from day one. So I didn't move into the business without an FSP license. I didn't move into the business without knowing that I have clients that's moving over. I didn't move into the business without having the financial services provider contracts in place. And so that probably saved a year and a half. If I only started that process the day, I resigned, or the day I moved into my business, how on earth am I going to cover expenses for a year and a half? And so what we did is we rented a place from day one because we wanted clients to feel that there's an office space. It's not just someone working from home. This idea of fake it till you make it, I'm not wonderful. Like, I don't really like the term, but there's an element in terms of make sure that you play in your favor, that someone feel like they can trust you and be trustworthy. So that those are things that you can control. And then I would say focus on the things you actually can control. You can control the conversations you have. You can control the questions you have. What you can't control is how that client responds. And almost always, it's not about you. It's about, they might not be going through something where it's not the right time to make financial decisions. And so start thinking about, what's happened to this person. Start, I think, having a little bit of empathy when things don't always work out your way. I think there was a tremendous amount of luck, knowing that where I'm sitting now. And yes, there's been sacrifices, right? It's meant that I have to put in hours over weekends and over the evenings. What I didn't do is I didn't see clients in the evening. And so I tried to create a professional, trustworthy structure where someone respected my time and that I get as much value as what they're getting. So kind of having a mutually beneficial. But lastly, the most important piece is have fun. Deal with clients that you enjoy dealing with. That might be an elderly lady that just wants to have some tea. Those can be one of the most wonderful conversations. You can you learn from someone that has this massive life expectancy or life experience. Be curious. Try and connect with people and understand what they're going through, and do the work that you feel you're created for. Right? I think we're here because we care and we have a passion. What didn't resonate with me is, picking the best product. And I started out thinking, oh, okay, if I can just construct a better portfolio, or if I can save someone a little bit of money on, their EACs, they'll move their business. They don't care. Like, most of them just say, okay, this is interesting for you. I can understand that there's an impact, but I'm worried about this bigger thing. Right. So think about what this bigger thing is in their lives and help them to solve that. Don't spend too much. You need to get the technical right, but don't spend too much time on the things that they don't care about. Right. And yeah, I think that's for me, that's it. And, you know, if you want to have a chat, send me a message. I'm always comfortable. I don't have all the answers, but at least I have some questions. And maybe it might help you look under a different rock and saying, oh, I like to go this route. Almost all of us have a passion outside of financial planning. And think of combining that. You know, Russell, you can target some of the guys in the gym and you can solve problems of the gym owners, and you can start thinking about the business structures, and, you know, start bringing in areas of your life that, you know, you're comfortable with and you enjoy. And yeah, it doesn't have to be that difficult. So just hang on tightly and enjoy the ride.
Okay, then Louis, lastly, so this business is still dominated by corporates. It's dominated by older advisors who work until long past their retirement date, not because they have to, just because they, you know, they don't have a life, I suppose, or they don't want to let go. How do you see, so how do you see this, where do you see this business in say 10, 15 years time? What are businesses going to look like? And what are you doing in your business to make yourself future fit in that way?
That's a very interesting question. I don't think I agree with the statement that it's dominated by large institutions. I think they have a role in creating products and distributing products, but what's not dominated is these close relationships, right? You can't scale financial advice, and no client wants to be scaled. What won't change in 15 or 20 years? It's that emotional connection. It's knowing that someone will be there to help you make a decision. And so where that comes from is when they asked Jeff Bezos, you know, where do you see Amazon in 10 years' time? He said, well, actually spend time thinking about what's not going to change, because we have no idea. I think we're terrible at predicting what the future is going to hold because of the law of compounding, right? Just as because we're equally terrible of thinking what an annualized return of 10% is compound over 40 years. You might have a guess, but once you see the figure and once you see how reality plays out, it's going to be very different from the discussions we have. So I'm trying to upskill in the areas that has less likelihood to change. Yes, you have robots that can have emotional conversations, but there's a certain element of connecting with someone that I think people will hold more dearly and that they'll be willing to pay for. And at the same time, we're seeing the shift from the role of the administrator because things are being automated. And so, what I'm thinking about is how do you build your business where you might not need as much staff? Like, what is the role of your team going to be in the future? I don't think we need to lose older financial planners because they have a wealth of experience and they bring a new perspective. So, I applaud these guys that's still willing to operate, writing RE exams, writing class of business, all the legislative things that have come our way and phase, and they've adapted, right? They've said, I still enjoy doing this. I still enjoy serving people. So I don't see that as a bad thing. What I think is great is that, we're seeing this wave of professional advice that people should be paid for, and they should be paid for well. Maybe not through the individual client, maybe it's employer-sponsored advice, and there's different avenues. But I try and spend my time focusing on the things I can control and the things that I also enjoy, just exploring and starting to stretch the skills a little bit. So I know it's maybe a bit of a cop-out saying I don't know I've got a few guesses, but I think they're probably all going to be horribly wrong. So just focusing on those things that probably won't change.
Okay, and I actually like that because we had a little conference last week and I kind of said the same thing. We're going ahead. We don't know what it's going to look like, but we go ahead in any case. Yeah. So.
Yeah, we'll be there. We're gonna. What will still be there is these communities, right? We'll still connect with each other and we'll figure it out together.
Yeah. Does anyone else have any last questions for Louis? Great. Okay, Louis, thank you so much. I know your time is precious. When I told the guys you were coming on the call, they were really excited. Thanks for all the wonderful work that you do, which we all benefit from. And yeah, we'll see you out there, bud. Thanks so
Thank
much.
you, Dick. It's fun chatting to you, and yeah, all the best. Like, really welcome to send me a message. I'll get back to you, and we're in this together, right? I've just taken a different route than a lot of other people. I don't think I'm ahead. We're at the right place where we are now, and let's figure this out together.
Excellent. Thanks so much, Louis. Really appreciate it.
Thanks,
Just
Louis.
bye-bye, guys.
Thank you.
Cheers, guys.
Thanks, Louis.
Bye.
Thank you. Cheers.